For a company that deals with the housing market, mortgages, but also credit markets more largely, to see this level at the 10-year, what is the ripple effect across all of your businesses?
So why don't we start with the mortgage market? And obviously, a couple of weeks ago, there was some big news where Rocket Mortgage bought a company called Mr. Cooper, and that was, I think, a $9 billion transaction. When you look at that deal, and I think about where we are in the space, the one thing that we have, which is, and Cooper has as well, is a large amount of mortgage servicing rights. So when you look at our balance sheet, we have $850 billion of mortgage servicing rights. If interest rates stay higher for longer, our ability to actually manufacture cash for our company and for our funds businesses, it's pretty extraordinary.
Well, how does that work? Because you look at the Mr. Cooper deal, and frankly, a lot of this was because these companies have gotten so large. They're not all that many at this scale. You know, you were behind this business kind of when it was growing up back in a prior role. So what does this mean for your business? Because in the commercial break, you were giving us some pretty interesting math about what it means for your stock.
So we own, when I was part of Fortress, one of the companies that we grew was a company that was known then as NationStar, which is now known as Mr. Cooper. In 2018, when we were at Fortress, we sold that company to KKR. If you look where we are today, we built a very similar company called Newrez. And we just reported earnings, obviously, on Friday. So if you actually took the valuation of Newrez and you applied the same valuation that Cooper has, as a result of that M&A transaction, it would imply roughly a $20 stock price for us.
How do you plan on exiting Newrez? I mean, when you talk like that, I think maybe an IPO, or is a sale a better choice? Yeah,
we're not going to sell the company. If you look at the world of credit, and actually moving on to credit for a sec, the kind of fund raising that's going on today is something called ABF, asset-based finance. This company makes a lot of money, and it provides a lot of cash flow for our investors. So I think the likelihood is, at some point down the road, we'll figure out a way to simplify our capital structure, maybe up top, because we trade within the REIT space. And one of the things to think about is we trade roughly 5 to 6 times EBITDA. If you think about some of the alternative asset managers trading at 10, 15, 20, 30 times, if we could get that increase in multiple, and based on the amount of money that we make today, if we make $1 billion a year, for example, if you put a 10 multiple on that, it implies a $20 stock price again. So I think a lot of the things that we're very focused on is how do we create more shareholder value? How do we grow our private credit business? And in creating shareholder value, we need to take a look, to your point, whether we take the company public or whether we actually change our corporate structure a little bit.
Interesting, and I'm wondering whether you're thinking about further M&A, because, okay, you're not going to sell Newrez, but you're known as being a pretty acquisitive business. Of course, a lot of folks know you from the tie-up with Sculptor, for example. You think about this environment right now. Are you looking to perhaps do some more purchasing?
So we've been pretty clear that we want to scale up our credit business a little bit more than where we are. So I would say the M&A calendar or pipeline is fairly active. The one thing that I point out that we trade call it 6 times EBITDA. If you think about that relative to someone else that's trading at 15 or 20 times, we got to be extremely selective on the potential acquisition target that we're trying to source. But the calendar is pretty robust right now, and I think valuations have come in a little bit.
Speaking of valuations, beyond Rithm's own potential M&A strategy, there's a word that I really love in markets right now, opportunistic. Back in the day, this used to be considered distress, but no one's calling it distress these days, maybe because these assets are not quite so dire in their straits right now. So what are you finding out there in terms of deploying a lot of capital for opportunistic, real estate, credit, anything else that's sold off?
So if you look at the volatility we've seen in the markets the past kind of couple months, we've actually taken that opportunity to source assets and buy assets. And again, going back to the word ABF, we could actually go out now and source assets that are kind of mid-teens type returns. That works extremely well for our funds business, and it works extremely well for the public company on the balance sheet side.
What do you expect in terms of opportunities coming up? We talk about Torsten Slok a lot on this program from Apollo, and he's been putting out some warnings about thousands of layoffs, bankruptcies at generational retailers, a recession coming because of empty shelves and COVID-like shortages. Do you buy into that?
I'm concerned. I mean, we should all be concerned that, the more and more layoffs that you see. I think it's going to be, how does that really weigh on the economy, and how do we think about our overall businesses? And actually, does that play into some kind of opportunistic, distressed environment? I don't think we're there now. You look at our delinquency characteristics on our mortgage portfolios, and delinquency trends are actually trending lower right now. I think it remains to be seen what's going to happen in the third and the fourth quarter.
I want to talk a little bit about your share price because we've mentioned it earlier in the show that you got an upgrade over at Piper Sandler on your valuation potential just this morning. They say that your stock is overly discounted. I want to look at how you've performed over the past 5 years or so, because at least according to our data, you're up 192% on a 5-year basis. That is outperforming the S&P 500 there, or at least on a total return basis.
And he just said it could double with Newrez.
Exactly. But one of the reasons that Piper Sandler has this view is that they have a whole list of reasons, but one of them is your ambitions to grow asset management further that could enhance the valuation. So just talk a little bit more about the opportunity set when it comes specifically to asset management.
So obviously in 23, we did the transaction with Sculptor. That's working out extremely well. Recently you probably have seen in the press the real estate team has raised $3.2 billion for their opportunistic real estate fund, the largest one they've done in 20 years. Their track record is excellent. We recently announced a credit opportunities fund at Sculptor as well, closing on $900 million. So we're starting to see some real flow come onto the platform at the Rithm level as well. So as we grow our asset management business, and then you change that so-called multiple valuation, that's really our goal. How do we get a better valuation for what we're currently doing every single day? And there's really no change. It's not like we're going to change how we think about the world just to grow in AUM. We need to grow in performance. Performance is going to lead to more AUM. But I think overall, if you go from a 6 multiple to a 10 multiple or 15 multiple, that's really going to be your pop in the valuation of the equity.
It's pretty remarkable to see anybody raise funds in this environment, frankly, and you guys have raised billions. And so what is it that investors want right now, particularly in private markets and credit markets? Are there places that they're avoiding?
It's a great question. One thing I didn't touch on is we recently launched a platform called Scale, which is energy and infrastructure. So some of our old Fortress colleagues are joining us to build what I would call power plants for the hyperscalers. So that's something that's an ongoing business. I guess when we look at the world and we think about where we're going to go and what investors really want, they want partnerships. So we're going to grow with partners. This is not like, I think back to the old days and all the M&A stuff we did. If we go out and buy a company, we'd go raise, $1 billion of equity, for example. Having real partners around the globe is something that's going to really enable us to grow. And I don't think it's really specific to us. I think it's more broadly in the alternative asset management business. And I think we're on the right path now. The past couple of years, we did a lot of brand building around the house. And I think now we're going to start to see the fruit of that labor really come into play for the company.